welcome. In this video, we will continue our discussion on the option Strangle by looking at an example of a Strangle trade on Bank of America. A long Strangle is a trade that combines two out-of-the-money options on the same stock, a long call and a long put, both with the same time of expiration. At the time of making this video, Bank of America is trading for $17.25 per share. A trader could place a Strangle by buying a call option with an $18 strike for 27 cents a share, and by buying a put option with a $16 strike for 17 cents a share, for a total cost of 44 cents a share up front. Both options cost 44 cents up front total, so for the trade to be profitable, the price of Bank of America either has to rise more than 44 cents over the $18 call strike, or the price of Bank of America has to drop more than 44 cents below the $16 put strike. This means that for the trade to make money, the price of Bank of America either has to rise over $18.44 or fall below $15.56 before the options expire. In other words, the price of Bank of America has to either rise more than $1.19 or fall more than $1.69 from its current price. A trader could also go further out of the money and place a Strangle by buying a call option with a $19 strike for 5 cents and buying a put option with a $15 strike for 9 cents for a total cost of 14 cents a share up front. Both options cost 14 cents up front total, so for the trade to be profitable, the price of Bank of America has to either rise more than 14 cents over the $19 call strike, or the price of Bank of America has to drop more than 14 cents below the $15 put strike. This means that, for the trade to make money, the price of Bank of America has to either rise over $19.14 or fall below $14.86 before the options expire. In other words, the price of Bank of America has to either rise more than $1.89 or fall more than $2.39 from its current price. The second example uses options that are far out of the money. For this trade to be profitable, the price of Bank of America must make a significant move in one direction, meaning that the probability of the trade making money is very low. However, if the price of Bank of America does make a significant move, the profit as a percentage of the amount risked can be very high. In this example, the price of Bank of America has to either move up almost $2 a share, or down about $2.40 a share, or the trade loses money. But if for some reason Bank of America were to move, for instance, $3 a share up to $20.25, the profit would be the current price of $20.25 minus the strike price of $19 minus the 14-cent cost for the options, meaning that the profit would be $1.11 on a 14-cent trade. In other words, the profit would be about 8 times the amount risked. This type of trade has a very high possible reward combined with a very low probability of success. As one buys options that are further away from the current stock price, the cost of the options decrease, meaning the possible profit as a percentage of the amount risked increases, but the increase in possible profit is directly offset by a lower probability of success. I hope you enjoyed this video. Thanks for watching. Hello and welcome. In this video, we will look at examples of a long straddle and two different long strangles that a trader could place on GLD, the gold ETF. You may remember from my video on straddles that a long straddle is a trade that combines two options on the same stock, a long call and a long put, both with the same strike price and time of expiration. Like the straddle, a long strangle is a trade that combines two options on the same stock, a long call and a long put, both with the same time of expiration. However, for a straddle, the trader buys options that are at the money, and with a strangle, the trader buys two options that are out of the money. Both the long straddle and long strangle trades are taken when the trader feels that the price of the stock will make a significant move in price before the options expire, but the trader is unsure of which direction the price will move. The goal is that the price of the underlying stock moves enough in one direction that the price for one option exceeds the loss on the other option, resulting in a profit on the trade. At the time of making this video, GLD is currently $129.09 a share. Let's look at a long straddle and two long strangles that a trader could place on GLD using options that expire in about 5 weeks. A trader could place a long straddle by buying both the $129 call option and the $129 put option. The call option costs $2.54 per share, and the put option costs $2.46, for a total cost of $5 per share up front. This means that, for the trade to be profitable, the price of GLD either has to rise more than $5 over the strike price, or drop more than $5 below the strike price. In other words, for the trade to be profitable, the price of GLD either has to rise over $134 or fall below $124 before the options expire. Instead of a long straddle, the trader could place a long strangle trade on GLD by buying the $130 call option and the $128 put option. The call option costs $2.07, and the put option costs $2.04, for a total cost of $4.11 per share up front. This means that, for the trade to be profitable, the price of GLD either has to rise more than $4.11 over the $130 call strike price, or drop more than $4.11 below the $128 put strike price. In other words, for the trade to be profitable, the price of GLD either has to rise over $134.11 or fall below $123.89 before the options expire. The trader could also choose to place a long strangle that is further out of the money by buying the $131 call option and the $127 put option. Both the call option and the put option cost $1.65 each, for a total cost of $3.30 per share up front. This means that, for the trade to be profitable, the price of GLD either has to rise more than $3.30 over the $131 call strike price, or drop more than $3.30 below the $127 put strike price. In other words, for the trade to be profitable, the price of GLD either has to rise over $134.30 or fall below $123.70. Looking at the three choices, the straddle costs the most up front at $5 per share, which means that it has the highest amount of money risked. However, the price of GLD has to move the least for the trade to be profitable. So this choice has the highest risk, but it also has the highest probability of the trade making a profit. The strangle that is closer to the money costs almost $1 less per share than the straddle. However, the price of GLD has to move a bit further for this trade to be profitable. The lower cost means that the strangle has lower risk than the straddle, but the need for GLD to move further for the trade to be profitable also means that the strangle has a lower probability of success than the straddle. The strangle that is further out of the money costs the least at $3.30 per share total up front. However, the price of GLD has to move the most for this trade to be profitable. The lowest cost means that this strangle has lower risk than the straddle or the closer strangle, but the need for GLD to move further for the trade to be profitable also means that this strangle has the lowest probability of success. As you can see, as the strike price moves away from the current stock price, the options are cheaper, meaning that there is less money at risk to lose, but the price of the underlying stock has to move further, meaning that the lower risk also comes with a lower probability of success. I hope that you enjoyed this video. Thanks for watching. Hello and welcome. In this video, we will look at the short straddle trade. You may remember from my video on the long straddle that for a long straddle trade, a trader buys two options on the same stock, a long call and a long put, both at the same strike price and time of expiration. For a short straddle trade, instead of buying both a call and a put on the same stock, the trader sells two options on the same stock, a call and a put, both at the same strike price and expiration. Selling both a call option and a put option creates a range around the current price. If the price of the underlying stock remains within that range, the trade is profitable. In other words, the trade is profitable if the price of the stock does not go above a certain price or below a certain price. The profit or loss from this trade becomes the difference between the upfront premium that the trader is paid for selling the options and the amount that the underlying stock increases above or falls below the strike price. If the price of the underlying stock is exactly at the strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless, and the trader keeps the full premium that he was paid up front for selling the options as his profit. The full premium that he was paid up front is his maximum possible profit for this trade. If the price of the underlying stock is not at the strike price, one option still has no intrinsic value at expiration, and still expires worthless. However, the other option does have intrinsic value. This means that the profit the trader made selling the options declines by that value. If the price of the underlying stock is above the strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the current price of the stock and the strike price. If the price of the stock is below the strike price, the trader's profit or loss is the premium that he collected up front selling the options, minus the difference between the strike price and the current price of the stock. If the price of the stock is above the upper break-even point, the loss on the call option exceeds the premium the trader was paid for selling both options, resulting in a loss on the trade. If the price of the stock is below the lower break-even point, the loss on the put option exceeds the premium the trader was paid for selling both options, also resulting in a loss on the trade. Often a trader will place a short straddle trade with the intention of closing the trade before the options expire by buying back the options for less money than the amount that he originally sold them for. Sometimes a trader will sell the options for a short straddle when implied volatility is higher, which drives up the price of the options, and then buy back the options when the implied volatility and in turn the price of the options decreases. For instance, sometimes a trader will sell the options to open a short straddle trade before an earnings report or economic report. The theory is that the expected result from the report has already been priced in. In other words, the price of the stock has already made the move ahead of time that will be generated from the report, providing the results of the report are as expected. The trader will sell the options heading into the report when implied volatility is still higher, and then buy the options back after the report is released when the options have dropped in value from both the decrease in implied volatility and the decay from the shrinking time left until the options expire. Let's look at an example using GLD, the gold ETF. At the time of making this video, GLD is currently $129.09 per share. A trader could place a short straddle on GLD by selling the $129 call option and selling the $129 put option that both expire in about 6 weeks. The call option costs $2.54 per share, and the put option costs $2.46 per share. Selling both means that the trader collects a total of $5 per share up front for selling the options. This means that, for the trade to be profitable, the price of GLD must remain within $5 of the $129 strike price. In other words, for the trade to be profitable, the price of GLD has to remain above $124 and below $134. The $5 premium the trader was paid up front for the options is the trader's maximum potential profit. If the price of GLD is at the $129 strike price when the options expire, neither option has any intrinsic value. This means that both options expire worthless, and the trader keeps the $5 he was paid up front. As the price of the stock moves away from the $129 strike price, one option still has no intrinsic value and expires worthless. However, the other option does have intrinsic value. This means that the profit the trader made selling the options declines by that value. If the price of GLD is between the $129 strike price and the break-even points, the trader's profit will be between $0 and $5 per share. If the price of GLD is above the $129 strike price, the trader's profit or loss is the $5 premium that he collected up front selling the options, minus the difference between the current price of GLD and the $129 strike price. The upper break-even point is $134, so if the price of GLD is above $129 but below $134, the trader's profit is between $0 and $5. If the price of GLD rises above $134, the trade loses money. If the price of GLD is below the strike price, the trader's profit or loss is the $5 premium that he collected up front selling the options, minus the difference between the $129 strike price and the current price of GLD. The lower break-even point is $124, so if the price of GLD is below $129 but above $124, the trader's profit is between $0 and $5. If the price of GLD falls below $124, the trade loses money. So that's the short straddle. I hope you enjoyed this video. Thanks for watching.